How do you pick the best strike price for selling a put option? In this video, I'm going to show you a few exact examples of how I pick strike price, what the best strike price is, and how to manage selling a put option when you do pick the strike price and things don't necessarily go in your direction. This is going to be a very quick guide, and I'm going to give you a lot of value in this video, so make sure that you stick to the end. So look, there's 5 considerations that you have to make when you are selling a put option when you are picking the strike price. Some of those factors are delta, support levels, implied volatility, and we'll go over a couple of more of those 5 factors. I'll briefly explain what selling a put option is and why you want to do it real quick. So selling a put option means that you sell a put and that position is essentially collecting income. You collect income when you sell a put option and then you're ready to buy a stock. You're ready to buy a stock at the strike price that you sell a put option at. The reason why you would want to do this is for better entry. We're going to take a look right now at NVIDIA. NVIDIA is going up a lot right now. This has been a stock that I have been recommending for a long time. And if you sell a put option, you can purchase the stock for a cheaper price than the current price that it's trading at. The first factor that we want to consider is support level. So a support level is basically where a stock cannot trade below. Theoretically, it can trade below, but psychologically or for other reasons like technical reasons, it's unlikely to trade below. So if I go to the chart right now on NVIDIA, I want to show you a simple support level that you can figure out where the support really is. One of the factors that I look at is the Bollinger Band. Right now you can see that the Bollinger Band is very wide. So NVIDIA is a very difficult stock right now to predict given the increased volatility. However, the example that I'm actually going to do is going to be American Airlines because this is one of the most consistent stocks that I have personally traded for a long time. So I want to show you instead an American Airlines chart and show you why this chart is a much more helpful and easy for finding a support level. So now you can see a chart that is very stable. American Airlines has been moving sideways for a long time, many months. And in fact, I've been trading American Airlines in my community for 5 years now on Discord. And if you want to become a student, by the way, you can just book a call. It's the first link in the description. You can learn about becoming a student. American Airlines here is very stable, and I've been trading it for a long time. And you can see here how there's huge support at around $9.60. There's huge support here at $9.90. There's a huge bounce here at 1082. And if you just draw a simple trend line, if I were to draw a trend line here, you will notice that it's just very strong. So for example, I can go from here to here. Okay, it's not drawing, but you get what I'm trying to say. Huge support at around $10 per share. Right now, I have chosen to sell $11 puts because that is the support level. See, the most important thing that you want to do is find support, and there's a couple of ways to do it. There's a Bollinger Band, there's just a visual chart. So for example, like visually, like you don't even have to be smart. You can like literally see here, it visually has a support level. So there's Bollinger Band, there's visual support, and there's also a moving average. So this red line right here is a 50-day moving average. And because American Airlines is below the moving average, that also is a good indicator that this stock is cheap right now, and selling put options would be a very good strategy to use. So now that we have talked about support level, and that can be done multiple different ways, from technicals to just looking at the chart or the Bollinger Band or the moving average, there's 4 different ways. And by the way, if you combine these 4, which is what I do with my students, I say, hey, let's combine and have a punch card. And the more things that are in our favor and the more clues and evidence we have, the better decision we can make. The next thing that you want to do is understand your risk. You can understand your risk by looking at delta. So delta is the most important metric that you can actually use. And I'm typically going for a delta that is as low as 15 for a stock like NVIDIA right now. Because it's so high, you would want to go for a lower delta. Versus American Airlines, because right now the stock is fairly cheap in the last 3 months, it's actually doing very well. It bounced very hard off of its lows here of $9. And now it has a steady trend. So I personally have some 11 puts that I have sold here. I'm already up. And if we take a look at the delta here, the delta is going to be higher. The delta on this option is 26. And that's completely okay. Look, the way that you pick a strike price is first of all based off of support, but second off, based off of delta. So if delta of an option is higher, you are going to get paid more premium. So you're getting paid more premium because there's a higher risk of you actually getting assigned. So if you don't really want to get assigned and you want to be careful, then go for a lower delta such as 15. However, if you want to have the good sweet spot, then you can go for around 25 to 30 delta. And if you want aggressive income, then there's nothing wrong with going 40 delta as long as you're okay getting assigned potentially on that trade. Remember, when you're selling a put option, your risk so to say, is assignment risk. You may get assigned shares if the stock hits the strike price. But if you want to own the stock anyways, then there's nothing wrong with getting assigned. So you can even go for a 40 delta. So what I can show you right now is if I go for a higher delta, I'm going to get paid a lot more money. So let's go to sell put option, and I'm going to go for an expiration date, let's just say in August, about 30 days away. Now, here, this 11 strike is going for 32 delta. But let's say that you like American Airlines and you're ready to own it. Well, you can also go for an 11.5 delta, and here, well, you can also go for an 11.5 strike price, and here the delta is 0.42. So in reality, you get to choose the strike price that makes the most sense for you and your preferences. And this is why understanding what you're doing with option trading is more important than even picking the right strike price, because understanding what you're doing helps you pick different strike prices on different stocks. You see, it's not a one set solution. It's really, how does this position benefit me and what risk am I taking? Next, I want to talk about implied volatility. Implied volatility is incredibly important because the higher the implied volatility, the more that you get paid. American Airlines right here has a 54% implied volatility. I'm typically looking for between 30 to 60. 30 would be the minimum, and 60 would be pretty much the maximum. Above that, it kind of gets too risky, and there's probably a reason why the stock is that risky. However, there's some exceptions. For example, Tesla, especially before earnings or some type of event, Tesla may have a very high implied volatility. Generally, a higher implied volatility is a good thing, especially if you're selling options. And when you're choosing a strike price to sell a put option, higher implied volatility is typically a good thing, all other things being equal. You actually don't want to have low volatility because you're not going to get paid anything. I recently made this an example in one of my boot camps that I was running this weekend, and I made the example on Coca-Cola, and I showed my students basically a very important lesson that if a stock has low implied volatility, you're just not going to make that much money. For example, if I go to Coca-Cola, and even if I give it some time, again, 33 days or 1 month away, right here you will see that it has a 19 implied volatility. That's because Coca-Cola is very safe and investors know that there's really not that much risk. So the implied volatility is, pretty low here. The delta is actually really high. So you have a very high chance of getting assigned, very low delta, and the premium that you're collecting here is just a little bit over 1% in a month, which is not really good. Instead, you want to target 1% per week. If you can make 1% per week, that's pretty much my goal. Then you can basically make 4% or more per month, especially when you start mixing in the other strategies that I teach for scaling portfolios. So it's much better to go for higher implied volatility because then you can hit bigger numbers and bigger returns per month, and then you can achieve your retirement goals much faster. Last but not least, I want to talk about days to expiration, or the time frame for choosing a strike price and selling a put option. The best time frame for me is really 30 to 45 days. The reason why I like monthly trading versus weekly trading is it's a lot less management. And when I'm working with busy professionals such as doctors, lawyers, or engineers, it's much better for them to have less management because they're not always available and they don't want another full-time job. Instead, if you can just trade, a couple of times per week, that only takes you an hour per week and a few hours per month, that's more suitable to the retirement lifestyle or even simply scaling your portfolio without having to put in too much time into it. So for me, the sweet spot is 30 to 45 days. However, I will also say if you're a beginner and you're looking to get more experience under your belt, oftentimes I do opt in for weekly trading. That's because weekly trading has faster theta, the option is decaying faster. It's more fun and you get a lot more experience very quickly when you're selling weekly options. However, be aware that you do have more gamma risk. As for monthly income and monthly trading, you have a much more smoother premium decay. It's much easier to manage. You have very little work. If you want more information on picking the right strike price for selling put options, I do have a put selling options course that is free here on YouTube, as well as a 6-hour free course. I'm going to leave that right here for you to watch if you want to continue to level up your game in option trading.